Good afternoon, everybody. I have promised to talk a little bit about the global economy, about global markets, what's going on. And obviously that will be the main topic of my speech, but I thought that since we are talking about fintech here today, I wanted to start out by reflecting a little bit about how I feel about that specific topic. Can I ask you how many in this room has used Uber within the past? Okay, you all have, and you're happy about it. Good. When I arrived to Helsinki yesterday, as I do in every city I arrive to, open the Uber app when I arrive in the airport, and I see, my God, it's here. I'm happy. So I push the button and I come out. I get a phone call from the Uber driver. He says, "Do you mind if I come out and give you a hug at the airport?" I said, "What?" "Yeah, because there's police all over the place." Yeah, that's fine," I said. I don't care about the legalities of Finland. It goes perfectly well into my annual report, no matter how the expenses are done. And so he didn't have to hug me. He was a nice guy, but no hugging. There was no police there. But it once again reminded me about technological developments. And what is happening with Uber is the clash between outdated regulation and technology. And when we talk about the financial sector, then it's exactly what is happening in my view, which is the main driver of the fintech world, is that we have two things going on. Or in fact, in the case of the financial sectors, we have three things going on. And this is what I call the Uberization of the financial sector. Because what we have now is, one, we have technological developments, and you have met some of the entrepreneurs, some of the drivers of that technological development in the past 2 days. But we also have regulation. We have regulation killing the financial sector all around the world, particularly in Europe and in the US. Essentially, we are turning banks into utilities, like power producers, like infrastructure. This is what we're doing to the financial sector via regulation today. We're saying you have to have so much reserve that you can never fail. You have to hold as much safe assets that you can never fail. By the way, you cannot sell this and this risky product to any client in the world. So what is happening is that we essentially just saying to banks, the only thing you can do is take deposits and lend it out at a fixed interest rates, and that's it. But there is a demand for something else. And that demand will be met. And that demand will be met on this. My former employer, Danske Bank, has recently introduced a new product called June. No, they're not paying me to say this. But I think it's rather interesting that you can now basically on your iPhone or whatever phone you have, trade small amounts of investments directly, essentially, via your bank account. Very interesting concept. How will that be regulated? Probably some regulator in Denmark is already freaking out and saying, this seems terrible. People investing and doing all those things. We better crack down on that. I haven't heard any politicians comment on it yet, but that will happen. But if they outlaw that, that will then pop up in an app in another place, in a globalized world. So that's the second thing, is that regulation is actually forcing clients away from the traditional banking sector into the smaller startups. I don't necessarily think that's a good idea, but that is happening nonetheless. The third thing is, of course, the marketplace is changing. Or rather, interest rates have been changing. Interest rates are extremely low in a historical perspective. The yield curve is flat. Banks cannot make money on the interest rate business. So you have to do something else. And these three factors, technology, regulation, and market pricing, in my view, is what drives the fintech development. Other than that, I have no clue what the hell you're doing here. Or rather, you have, but I don't know more about it than you. So let's return to the global macroeconomic scene. There I feel more comfortable. First of all, something wonderful have happened this week. Donald Trump is in deep shit. And those of us in Europe is just saying, why did you just do that? Why did you elect this guy? Well, in my view, Donald Trump was not elected because of some fantastic rise of racism or protectionism or craziness in the US. No, it just happened. It was just a freak accident, and freak accidents happen. And the freak accident was that the Democrats insisted on having Hillary Clinton as a presidential candidate. Had they had a dog or a car or Joe Biden as presidential candidate, Donald Trump would not be president. Well, he will not be president for much longer if it continues like this, but it was just a freak accident. So let's not put too much, in my view, analysis behind it and say, oh, it's because of underlying currents against protectionism and we all moving that. I don't really think that is happening. It's the same thing with Brexit. We had Brexit. Well, don't ever ask voters about anything when they can answer no. Because no means I hate the politicians running the country at the moment. And, you know, the majority of people hate the politicians running the country in any country in the world at any time. Brexit wasn't about the EU. It was about the fact that people didn't like David Cameron. And he was, well, he's no longer prime minister. The people succeeded. And now the Conservative will have a fantastic election. What I'm saying here is that maybe we shouldn't put too much into populism as a factor. But there has clearly been a rise of populism in Europe, whether it's Syriza or Golden Dawn in Greece, or whether it's the True Finns in Finland, or whether it's the Swedish Democrats in Sweden, or whether it's the Danish People's Party in Denmark, or Geert Wilders in the Netherlands, or Le Pen in France. There clearly has been a rise of these forces, but I would also argue that actually that is a thing of the past, luckily. And that is interesting because until now, everything that had happened after 2008 has played out exactly as the 1930s. But maybe it's not playing out now as the 1930s. Are we seeing the death of populism? Well, see here. This is the approval rating of Donald Trump. And I'm sorry, I had to send in the presentation a couple of days ago. He's now down to 39%. And, you know, it's getting down to Nixon levels of love, or not of love, for that man. Donald Trump is not tremendously popular. The US has never had as unpopular a president at this time of the presidency. So populism is not winning. Populism is losing big time right now. You can see him there. This is the index of political uncertainty, something called the Economic Policy Uncertainty Index. I quite like the idea. It's kind of big data. The idea is to go out and look in newspapers and websites for words that relate to political uncertainty, and make an index of that. And you can see, if you look at the level of political uncertainty measured from that in the US, it's actually lower now than back in 2011 and 2012, when we had the so-called fiscal cliff, the debt ceiling debate, the closure of government, as they were talking about. It's actually lower now. And it might have peaked. And, well, in fact, in terms of the political situation, Donald Trump now is a lame duck president. he cannot pass anything. He's so unpopular, so much in crisis that he will not be able to pass anything, good or bad. And, well, that's what Americans call gridlock. And normally, from an economic perspective, that is quite good. Well, here in Finland, you would like to see some action about doing something about the workings of the Finnish labor market or your pension schemes. But overall, governments that can't do anything are better than very activist governments. So it might not be the biggest threat. But let's move to, do you like the pictures? This is Europe. This is political uncertainty in Europe. Again, it has peaked. Political uncertainty in Europe peaked a year ago. Obviously, that is to a very large extent driven by Brexit and the fears over that. And when we talk about Brexit, if we go to the UK, in the UK, political uncertainty has peaked. So what I would argue is that political uncertainty is not a major driving factor of the economic developments that at the moment. And in many ways, we should think of political risks as a lacking factor of the economy. I have a good friend, esteemed British-Canadian economics professor, David Leitler. David, he's a professor at a Canadian university. And when the ECB, the European Central Bank, in the early 2015 introduced quantitative easing, stepped up money printing essentially, I wrote David a mail and said, finally the ECB is doing what is needed. This is the right thing. And David writes back and said, I very much agree that this is the right thing, but I fear it's too late politically. And David was right. Essentially, since the beginning of 2015, we started to see Europe in political terms going very, very badly wrong. Because politics change with a lag. If there's a shock to the economy, gradually unemployment will go up, gradually wage growth will slow down, and gradually people will get pissed, and then they start to vote for the true Finns, which actually in this country isn't the worst thing you could do. That was not an endorsement. I can understand you guys. You should never have joined the euro. But the political reaction is lacking the economy. And I would actually argue the reason we're now seeing populism on the decline. Geert Wilders didn't do well in the Netherlands. Marine Le Pen did not become French president, thank God. And Donald Trump might soon be out. And the Brexit, well, that might be much softer than we now fear. But let's see. Why is all that happening? That is happening, in my view, because we are seeing signs of an improving global economy, and particularly this region, the Eurozone, is beginning to do much better. Let me first tell you a story about one of my favorite economists, philosophers, John Stuart Mill, who 169 years ago wrote about what he called the monetary machine. John Stuart Mill said that if monetary policy works well, nobody notices. It doesn't. If monetary policy is rightly calibrated, it's just there. We don't talk about it at all. The economy works well. But when the monetary machinery breaks down, the real machine, the machine of economy, breaks down. And I would like to add to that, if the monetary machine breaks down, the political machine breaks down. When monetary policy becomes too tight because Jean-Claude Trichet, the then ECB governor, in 2011 decided to hike interest rates twice and further putting Europe into crisis. When he did that, public finance problems exploded all over Europe. The only way to do anything about that was massive fiscal austerity. And that had to be implemented by somebody on the center left, on the center right. As a result of that, we saw the rise of Syriza, for example, in Greece. I'm not against austerity. Austerity is necessary if you cannot spend more money than you have. But if monetary policy is wrong, you will have to do more austerity than otherwise. And what happens in Europe was that monetary policy for far too long, unlike what people says, was too tight. Right now, it's about right. But it was far too tight. Maybe I should reflect a little bit on Finland here. I remember being in Finland, well, I've been in Finland very often, but particularly in 2010, when we had Southern European problems. I remember one night in Helsinki sitting and drinking beer and Jalo with Finnish colleagues. And they all said, oh, the stupid Greeks, they, lazy, they don't work, they don't save enough. They should do as we have done in Finland in the 90s. We did austerity, we did all the rising. Yeah. 8 years later, you look back and said, well, how did you do, guys? Not really well, did you? Finland failed. Finland failed miserably in the past 8 years. Growth has been meager. Finnish growth has been worse than in meager little Denmark. Compared to Sweden and Norway, pathetic. What has been the fastest growing nation in Europe since 2007? In Europe, in the Nordic countries? Iceland. The slowest growing? Finland. Do something about your labor markets. Leave the euro. Do something. That's why you got the true Finns. Because people are pissed off there's no growth. But the true Finns will no longer do well. First of all, because the joint government, which is a stupid thing to do when you're a populist. Second thing, Europe is doing better, and even Finland is no longer so pathetic. You still don't have a real good iPhone product. But anyway, Europe is having a comeback. This is Greece. 10% growth in retail sales year on year in Greece. Better than Finland. Much better than Finland. Do you know who works the most hours a year in Europe? The Greeks. Who works the least? The French, the Danes, the Germans, and the Finns. What is happening? Well, the story is really one of growth stabilization. In 2014, the ECB did what was called the LTRO3, was basically a lending program, easing monetary policy. 2015, implementing quantitative easing. A lot of people were against that. Bank of Finland thought it was a horrible idea, but went along with it anyway. It was a great idea. When you have inflation, you print less money. When you have deflation, you should print more money. We had deflation, we needed to print more money. That's the right thing, and it's working. As a result, Southern Europe is beginning to grow. And Finland is beginning to grow again. Why? Because the monetary machine that John Stuart Mill was talking about is beginning to work again. As a result, the economic machine is beginning to work again. And poof, populism goes away. Obviously, that's bad news for the true Finns, but very good news for Finns. And you will not leave the euro anyway, because now the economy is doing better. A way to think about that is to look at how is monetary policy calibrated in Europe. We have a monthly publication called Global Monetary Conditions Monitor, where we track monetary policy in 26 countries around the world. We have an indicator for the level of monetary tightness. If that indicator is 0, it means that monetary policy is calibrated in such a way that the central bank of that country will hit its inflation target. For the past nearly 3 years, 2.5 years, the indicator for the Eurozone has been basically zero, meaning that the ECB has been on track to deliver 2% inflation. It is, of course, doing that right now and should be expected to continue to do that. Believe it or not, the ECB is doing a fairly good job right now. I never thought I would say that. I am the ECB's biggest critic, but they are actually doing a fairly good job right now, so they will deliver 2% inflation. The monetary machine works. Mario Draghi, in that sense, has succeeded, and therefore, many of our worries are going away. And as a result, the populism is going away, but another thing we have had over the last half year, worries about the Italian banking sector. It has gone away. I don't think it's permanently going to go away. I think Italy has very serious structural problems. I don't think that the troubles in Europe is going to go away, because I think fundamentally it's an insane construction that should never have happened. But right now, monetary policy in Europe is calibrated as such that we're likely to see growth around trend, and we're likely to see inflation around 2% going forward, and that's not too bad. How about the US? You remember when Donald Trump was elected on November 8th? It was quite a bit of a shock to most of us. And I must say, mentally, I spent many nights and days thinking about how horrible this guy is and what kind of horrible things he could do. But how did the financial markets react? This is when I get crazy nervous about some things. I look at the stock market and say, is it really that bad? You know, not long ago there was worries of nuclear war with North Korea, and I look at the stock market. If stock prices are up, it's just fake. It's not really happening. It's just headlines. The stock price, the stock market is always the best indicator of the state of the world. It might be wrong, but you have nothing better than that. Because it's a crowded, it's a combined wisdom of the crowds. What happened when he won? Donald Trump becomes president. On election night, he says something. And that is really what drives markets. He says, I will build roads like no one before. And a great wall, the biggest wall in the world. And I will give you tax cuts, and I will not cut spending. This is what we in school is taught is called Keynesianism. It's fiscal stimulus on a 1970s style at the absolutely wrong time. Unemployment is down to pre-crisis levels. Inflation is nearly back where it should be. And then Donald Trump has to set around, I want to ease monetary policy. Oh, not monetary policy, fiscal policy. And people say, my God, he really intend on doing this. That has been the problem with Donald Trump all along. He's actually doing what he said he wanted to do, which is kind of a problem given his insane ideas. So he says he will do this. What happens is that inflation expectations jump. That is the light green line there. You can see in November there's a big jump in inflation expectations. Why is that? That is because at that time inflation is below the target of the Federal Reserve, the 2% inflation target. So he comes in and says, I want to spend more money, boost demand in the economy, and inflation expectations jump. As a result, the macroeconomic situation in the US immediately starts to improve. The dark blue green line is Citibank's measure of economic surprises. So this is how macroeconomic data comes out in the US relative to the expectations ahead of the release. And you can see there's a very close correlation between that. However, I wrote an op-ed in a Danish newspaper a couple of months ago saying, luckily Donald Trump is only president and not Federal Reserve chairman. Because the important thing is not who is president, but who is Federal Reserve chairman. or in the case here, chair, as Janet Yellen likes to call herself. Because see what happens when inflation got up to 2%, inflation expectations, it stopped rising. Why? Because if it moves much above 2%, what will the Federal Reserve do? Hike interest rates. So every time Donald Trump promised a new wall, a new road, a new rate cut, a tax cut, we will just see more aggressive reaction from the Federal Reserve. Donald Trump cannot beat the Federal Reserve. Well, he will not be president for much longer, but anyway. And look then what happens in March. On March 3rd, Janet Yellen comes out and says, by the way, we will hike interest rates in 2 weeks' time. She didn't say that directly, but nearly. Directly enough for the markets to understand it. And then she delivered a rate hike on the 15th of March. Way ahead than earlier expected than the markets. Then on April 4th, the minutes from that meeting in the Federal Reserve, the FOMC meeting, was released. And in the minutes it was said that the FOMC members was discussing what is called balance sheet normalization. Meaning essentially, instead of printing money, you do the opposite. You sell your assets you own and you reduce the money base. That is monetary tightening. That scared the markets. So that's the next downturn we get in early April in inflation expectations. But look at the city surprise index on that. So what have happened in economic development in the US is first Donald Trump comes in and says, I'll build a wall. A wall is not economically good, but it can boost. It can boost demand. By the way, that wall, Donald Trump apparently didn't look at the immigration statistics in the US because he wants to keep out the Mexicans. But over the past 6-7 years, the Mexicans have actually been leaving the US. So what the result would be of a wall is he will keep the Mexicans in the US, which is really good news, by the way, for the US economy, because large parts of the US economy would not work without immigrants. Well, it would be a very tiny nation with no immigrants in that country. So the Donald Trump boom was really very short-lived. It was based on what he said on election night, and Janet Yellen has killed it. So how about monetary policy in the US? Well, I already alluded to that. Janet Yellen was eager to hike interest rates. I would give Donald Trump one thing. He's right when he says that the Federal Reserve is political. Ahead of the elections, Janet Yellen said, we need a high-pressure economy. What did that mean? That meant that we would accept the US economy overheating for a period because it has been weak for so long. So to get everybody into the labor market again, you needed overheating. At that point, I'm pretty sure Janet Yellen expected her fellow Democrat, Hillary Clinton, to become president. So had Hillary Clinton come in and said, we are doing tax cuts, building new roads, Janet Yellen would have said, fine, we would allow inflation to run a little bit above 2%. But that didn't happen, did it? So Donald Trump is not getting anything. So Janet Yellen came out fairly shortly after Trump was elected saying, no, I was misquoted. It wasn't really what I said. Well, it was on paper what you said, but she ran away from that. And as I said, they started to talk about hiking interest rates. Again, this is our indicator for monetary conditions in the US. It's actually below 0, which indicates, and this is based on the developments in interest rates, in the exchange rates, in nominal demand, and in the money supply. It actually indicates that the US is likely to undershoot the Federal Reserve's 2% inflation target in the next 2-3 years. It's already below that, but it continues to undershoot that. So the Federal Reserve really shouldn't hike interest rates. 3 weeks ago, we put out a publication where we said that the Fed would not hike interest rates anymore in 2017. At that time, the market was pricing in a 90% probability of a rate hike in June. So it was a somewhat courageous statement. Actually, when I was making the statement, I thought I would be wrong. But you know, making bold statements gives you a lot of attention. But now, 3 weeks later, the likelihood in the markets of a rate hike in June is down to 65, 68%. If it continues like that, there will be no rate hike in June. And there shouldn't be a rate hike. And if they hike rates, they will come to regret it. So yes, they might deliver that one rate hike, but I fundamentally don't see much room for it. But that being said, the US economy is growing nicely. Inflation will be close to 2%. And unemployment is down to below pre-crisis levels. Which is really a nice thing. You know, we have Europe doing fairly well. We have the US doing fairly well, despite of the politics. So what about the second largest economy in the world? Too bad. It's actually also doing quite well. What is the Chinese story? Well, there is a Chinese story which looks 10, 15 years ahead. And if you ask me about that story, I can tell you a very depressing story. I'm quite concerned about Chinese long-term growth. China will, so to speak, grow old before it grows rich. The one-child policy was a very stupid policy because children are future workers. So when you say you don't want to have any kids and you don't want to have any immigrants, meaning then you will have no labor force in the future, meaning you will have no growth. And that is what is happening in China to a very large extent. Very low population growth has caused the labor force to start to shrink in China. So longer term, I'm pretty concerned about Chinese growth. We probably have trend growth around 6-7% now. It's coming down within the next decade to 3%. Within the next 2 to 3 decades, we are down to a Japanese situation with essentially no growth in the Chinese economy for a very long time. China will never be the largest economy in the world. But China is not about to crash. And China is doing fairly well right now. And I believe one of the things that has been important that hasn't been talked too much about is that the People's Bank of China, the Chinese central bank, in mid-2015 started a gradual depreciation of the Chinese renminbi. It allowed its currency to weaken. Consequently, you are having monetary easing in China, and that has helped stabilize Chinese growth. But it's also helped stabilize the world. One of the reasons why over the past year, commodity prices has rebounded. So China is not doing too bad. And if you look at our indicator for Chinese monetary policy, it's exactly 0 right now. So what I'm saying is that Europe is doing fairly well. China is doing very well. The US is a little bit too eager to have interest rates go up, but you know, they will not mess up completely. Which means that this presentation is extremely boring. Populism is gone, and the largest economies in the world are growing on trend, and inflation is there, and there's no major problems. The only problem is, how am I doing on time? So, I have been told that I can ask whether there are any questions. Do we have any? And remember here, you are not finished today, so you are allowed to ask questions. There was a question. Yes. The question is, why will China never be the biggest economy in the world? My flight back to Copenhagen is tomorrow night at 8. I start now on China. How many will stay around? The story on China is 3. There are 3 drivers of growth in the long run for any economy. 1, labor. No, let's say we make this little conference room into a newspaper. We are all journalists. We produce a newspaper. So that's the first factor we have in any economy is the people, the human capital. The second thing we have is typewriters or computers. That's the actual capital we have. The third thing we have is know-how, the way we actually are able to use the computer. So those are the three factors. The know-how is what economists call total factor productivity. If we start with the labor, I already alluded to that. The Chinese implemented the one-child policy. As a consequence, population growth has been slowing. And in the past 7-8 years, actually labor force growth is now declining. So there's simply less journalists in the room. Some of you are leaving. Second thing, if we sit here and there are no computers, no iPhones, no nothing, and we have to write a newspaper, it will be rather hard. Now we bring in one computer. That increases productivity quite a bit. Fast forward in China, this is like what is happening in 1990. The first computer, the first capital comes in. You don't only have labor, you also get machines. Now, fast forward, we all have computers. Some guy comes in. Whatever. Samsung. He comes in, he has a computer. He said, hey, I have a new computer for you. And you're all sitting with your computers. The return on that computer is very low in terms of further production. That is what have happened in China. There was a tremendous catch-up because of the return on capital was high. But if you look at it now, China is actually over-investing. Investments in China relative to GDP is close to 40% of GDP. In countries like Brazil or India, it's half of that. So China has massively over-invested. China have had the same growth strategy as Hitler had in the 1930s. What happened in Germany in the 1930s was subsidizing investments, a lot of public investments, subsidizing exports, and taxing consumption. So you tax private consumption, give the money to your exporters who can then export cheaply. And essentially that's what has been happening in China. We have not had very high growth in private consumption in China. We've had very high export growth and very high investment growth. As that is being normalized, so to speak, you will get less investment growth. So you will get better growth, but you will get lower growth. So that's the second thing, is that we have lower effect from capital accumulation, that return on that is lower. And then the third thing, the catching up. Well, this is produced in China, likely, I think. It was designed somewhere in the US. But now the designs are moving to China as well. So they're moving up the scale on the value chain. So how much more effects that on the return on total factor productivity, on the knowledge? We have transferred knowledge, well, the return on that is small as well. So these three factors means that China will slow down, and their population growth is the most important part. So that makes me quite bleak. I have a quite bleak view on China for the longer run. But again, China is not about to explode. There is no Chinese bubble as people are talking about. And being the second largest economy in the world is still pretty good, growing 6% a year. So, I'm not discouraging you from doing business in China. I'm just saying that it's not going to be the dominant power in everything. Should I end this, or should I take more questions? It's fun that our Finns are asking questions. A last one, and then I'll allow you to leave. No questions? Oh, there in the back. Thank you. Good. Perfect. Put your money where your mouth is, or the opposite way. First, I will tell you how I am invested myself, and then I will answer the question. Before starting my own companies 2 years ago, I worked for 15 years in Danske Bank. As part of part of the package, you would get stocks in the company, in the bank. I always sold it the day I could sell it. And people said, don't you believe in the bank? I said, well, I have fantastic trust in the bank. In fact, I still have fantastic trust in Danske Bank. It's still my bank. But why would I expose myself, both investment-wise and in my job? So if Danske Bank was doing bad, I would lose on my investment and lose my job. So I did that out of a hedging perspective. The other reason I did it was I never wanted to have any open financial positions where I was in charge myself. So everything, and to this day, all my investments are managed by somebody else. Because I exactly advise people on where you would put your money. So that's the disclaimer. That does not mean that I wouldn't take the bet. I'm just saying that if I had a position, that would influence my view. So it doesn't. In 2010, I was very depressed about the world. Not about my life, but about the world. And I did a presentation in Copenhagen at a big investor seminar, and I got a question which was exactly the same. If you had 100,000 euros, you could put it in one stock market in the world, where would you do it? I had just had 1 hour's presentation on the outlook for the African economies. So my answer was, I would take that money and put it in the Tanzanian stock market because I have very high hope for African growth. And I was married to my wife in Arusha in Tanzania. She's as Danish as I am, even though she grew up in Africa. So, for that, and she's a PhD in biology, but she's really good investment advice. When we got married in 2007, I sold my apartment half a year, less than a year before the crash, put all the money into Swiss bonds. And then in 2010, she convinced me to buy a house. That has been fabulous investment advice. So I'm listening to my wife. What I would buy is actually, from a long-term perspective, I would look at Africa. Look at Africa. It's a long-term, interesting story. If you want to have a short-term, next half-year trade, buy Swedish krona, sell Canadian dollars. But that's another thing. I think we're done. Or are there more? Then it's time for drinks. Thank you very much. Do you have any?
Thank you very much. Thank you very much, Lars. That's the most interesting. It was especially the honest part about Finland I really loved because.
Well, we can do that in another seminar without politicians.
Yeah. It's seldom you hear so much truth being said about. I mean, we had the Nokia, the export failed, the strong euro, Russia going down, collapsing under us, and the labor market not being that dynamic, but that the wages going up and the public sector going up. So we have had our struggle during the last 10 years, I would say. Now probably we start to see a little bit of light in there. And it's nice to hear that you said that the globe is also going well. So we hope for that, and give a big hand for Lars again.
Thank you.